Let's roll on crude. All right, what I said this morning is this. When you buy and sell these markets, guys and gals, the first target hit on this one. Let's get this off here. What I talked about when I got on the mic is this. I had two sell levels. What we did is we established we were in a downtrend right here. The magenta was in a hard angle down. Pretty much all morning since around 2 a.m. this morning. Angle down, right? So I had a short bias coming into for you guys. And I said we only got two setups. If we break down through low value area, which these are these green lines right here, the green line, low value, right? That was 71 at the time. Break through 71, retest 71, that would be the sell level, all right? And that's what we did. The reason I said that level is this. When you first log in the trading room, I want you to look at these black charts. If that magenta is angled down, then you're in a downtrend. You can only sell the break of LVA, retest of LVA, or sell the first test of HVA. So what I said is this. I looked at volume profile to the bottom left, and I said we got 0602 as resistance. So our sell level 0602, and then we have the hedge fund at 06. So right here would have been a sell level right here at this level. If we would have came back up there. If we would have came back up there, that's a sell level right there. On HVA, that's HVA, high value area. Right? And then we had one at 24 also, above that. If the market's too weak and you can't sell the first test of high value area, that's what we do in downtrends, right? We sell the first test of the red dots or hedge fund. Then I said if we broke down through low value area, because low value area was at 0571 on price profile, volume profile was 0576, my developing profile right over here was 0578 at the time. I said if we break down through that, let's pick the lowest low, 71, on the price profile of all three profiles. We break that level, we retest that level, look for a Fibonacci dot, and then we'll get in the trade. We got the Fibonacci dot. If you don't get a bullseye with the yellow dot in the middle, you look for the first red bar reversal to enter the trade. And this is how these traders got on it. They posted in the morning. There's your first red bar reversal. The reason I said that is that our first target would be the previous low a day, 0536, and then we got a target all the way down here to 0492. It's a huge trade. We got a real big trade on our hands right here, right? So the market did exactly what I anticipated. I said either come back to 06 and we short, or we come down to break down 71, retest 71, and we go short for an ABC short. This is a number three trade. The reason this works so well, immediately once you break LVA in a downtrend, you have to think one thing, ABC short. If you break out of HVA, the first thing you think of is ABC long. And this, now remember, market profile has worked for nearly 30 years. 30 years. This same setup is just trading order flow. The reason this works over and over again, you'll see hundreds and hundreds of trades in all markets like this. You're predicating your trades off the wrongly positioned traders. Because what happened right here is a wrongly positioned traders, we're at LVA right here, LVA support, LVA support, LVA support at 76, 71. Here's developing at 78. They all had support. So once you break down through LVA, it's going to take all those wrongly positioned trader stops. And what happens is it's going to be a self-generating trade because it's an electronic traded market. There's no buyers to hold the market up. They got to keep dropping price until buyers come in the market. And when you have no support below LVA, there's no buyers until you get down to at least the previous low day, or you get down to 0492 support. And that's why it's a self-generating trade. Because if once you get below low value, you retest low value, look for the first red Fibonacci dot, red bar pull in, or bullseye, and there's our trade we called out this morning, giving you a heads up on that trade. They were all three profiles confirmed. Volume profile confirmed, price profile confirmed, developing that works on your own ninja charts. This comes with J signal right there. It broke the green. Once you break the green, you're in the weakest part of the market right here. You look for an ABC short. It's as simple as that. Don't make it any more difficult. Just like Earl got on that natural gas trade, number 3 short. Just like on gold, that big move up, number 3 long yesterday, number 3 long today. They were all based upon that huge move on gold this morning. was based upon breaking through the HVA. Wrongly positioned traders get their stops out. We're on the opposite side. When you start trading on the opposite side of retail, that's when you're going to start showing consistent results with market profile. And that's what it does. It shows us where these areas are a major support and resistance. We knew 71, I said 71 before it broke it, is the breaking back in the market. That's a breaking point in the market because it's my lowest market profile I have. LVA was at 71. Volume profile is at 76, and my developing was at 78. So I said if we break 71, that's a breaking point in the market. You retest it, you get a Fibonacci dot, red bar reversal. We had limited risk. Look at our J signal. Limited risk, there's our black line for our limited stop. And there we go. Then what you do is this, scale your contracts. First set of symmetry dots, I cannot trade without my symmetry dots. Tells me to scale 50% of my position. If you do 4 contracts, sell 2 here, take it down to the next symmetry dots or previous low of day. I said that's a target. You can build 75% of your position at the next set of symmetry dots. Your last position you can hold all the way down to 92. The reason you scale is because you don't want your position to go short up here at 74 or 73, whatever you got filled, and come all the way down to the 20s and let it go all the way back up and stop you out. Scaling reduces risk. That's why we do symmetry dots.